Hello, I'm Rodney Jones from the Agricultural Economics Department at Oklahoma State University, and again, welcome to the next in the series in the Farm Transition Workbook video series. In this particular session, we're going to talk about looking forward from a financial perspective. In the last video, we talked about looking at past performance and some of the aspects associated with that exercise, and we referenced some other materials. In this segment, we're going to talk about evaluating financial feasibility. Can this thing work? Will it work looking forward? So, one of the first and foremost components of that examination is to step back and take a good hard look at how big the business will need to be. That is an important aspect of planning for a farm family business transition, and I hope to make the point regarding why that's one of the important components of that process here in just a minute. How big the business needs to be has a few different aspects associated with it, one of which you've probably all heard about many times, and that is, of course, the need to be a low-cost producer as it relates to being large enough to capture economies of scale or to be a low per unit cost of production producer. I'm assuming that anybody going through this business transition process has already got that one figured out. We already at least have figured out how to be a viable producer. So the next component of that needs to be an examination of whether or not the proposed operation will meet the needs of the various stakeholders who are going to need to draw some money out of that operation for income purposes. And that really boils down to the question, how many people can the business support? Now, why does this become an issue when we talk about family business transitions? It becomes an issue for a couple of reasons. First and foremost, quite often when a family business is contemplating a transition to the next generation, it's because someone in, for example, what we're going to call, for lack of a better term, the quote-unquote younger generation, has made a decision that they want to return to the farm. And maybe they've made that decision at some age, say their early 20s. That probably means that the quote-unquote, and I don't want to offend anybody here, the quote-unquote senior generation may still only be in their 50s, perhaps early 60s, but perhaps has no intention of completely retiring from that family business in the immediate term. So what happens is we immediately begin thinking about making the leap from a business that historically, at least for the last several years, has been supporting one family. We'll call that maybe a one full-time equivalent farm, to now thinking about the possibility of adding more participants that are going to need to take a family living, quote-unquote, draw off of that business. The problem is that people, full-time equivalents, quite often come in chunks of one person. We have to find something to put that person to work, and on a modern farm or ranch, one person can and needs to generate a tremendous amount of productivity, and in order to make that happen, it requires a tremendous amount of dollars worth of other assets, and that often again becomes an issue, at least during a certain phase of the transition process. So it's something to think about. We always think there's plenty of work to be done. We'd love to have somebody come back to the farm, especially a family member, wouldn't we? Leads to the assumption that just because there's a lot of work that needs to be done, that we can somehow add that additional person and everything will be okay. But will the farm need to provide all of the income for that person or that person and their family, while at the same time still providing an adequate income for the people who've been pulling an income off of that farming operation, at least for the last several years? What's the expected standard of living of all of the parties? And is there a willingness to phase into this process slowly, or in some other way, shape, or form make some sacrifices on the part of somebody? Let's look at this in a very scientific framework. What's the required level of net income currently? How has this farm been managing in its existing state? And what might the required level of net income be after somebody comes back to the farm, and for a time period there needs to be more family living withdrawals generated by that farming operation? The second component is going to be to calculate what level of gross income is needed to generate that previously mentioned amount of net income. And then how large of an asset base, how much investment is going to be required to produce that level of gross income. Let's just work through an example here that would be fairly typical of maybe a historic one full-time equivalent farm. Maybe the existing farming operation might look like this. $50,000 that the farm generates for family living and maybe to grow a little bit. By the way, that $50,000 is less than the average number out of benchmark data sets like the Kansas Farm Management Association data set. Average family living withdrawals in that data set in 2013 were between $65,000 and $70,000. So I put a conservative number in here, $50,000. We divide that by a ratio that we get from our financial analysis called the net farm income from operations ratio. That's basically the net income divided by the gross. A good number, a good example number there would be 0.2. And we're also going to need the asset turnover ratio, and I talked about that in the last video segment. That's going to be the gross farm revenues divided by total farm assets. So let's just work through the numbers here. That $50,000, if we divide that by 0.2, we get a net income needed by this operation, we get a gross revenue that this operation needs to generate of $250,000. That might sound pretty low to some of you, might sound pretty high to some of you, but it's just the example I'm working through here that would be representative of maybe a typical farm that we might be looking at. Then we take that number, that $250,000, and we divide it by the asset turnover ratio, and mathematically, by definition, that's going to tell us how large of an asset base would be required to generate that $50,000 family living withdrawal on a year in and year out basis. And in this example, we get a little over $700,000. Maybe that's the farm that this farm has been for the last few years, maybe growing slowly over time. Now, think about the scenario where all at once that family living need goes from $50,000 supporting one family on the farm to $80,000 or $100,000 supporting not only that existing family on the farm, but another family, a young person returning with a spouse and a family. Maybe it goes to $100,000. What does that do to the level of gross income that that farm needs to generate? And what does that do to the size of the asset base that that farm is going to need to operate in order to do that? You just run through the math and work through those numbers, and by definition, if you double the family living withdrawal, you double the gross income needed, you double the size of the asset base. So maybe, I don't want to discourage anybody here, but that might lead to some discussions about how we get from here to there. Do we need a slower process? Do we need a process that involves some off-farm employment income for a while we build the asset base? Do we need to delay some aspects of the transition until the exiting generation doesn't need quite as large of a family living withdrawal off of that business? Second component that I want to talk about in this financial feasibility discussion is budgeting. We'll briefly talk about three types of budgets: enterprise budgets, cash flow budgets, and partial budgets. Why do we budget in the first place? We budget so that we can test ideas on paper before we commit a large amount of financial assets to a particular production process. So we can use budgeting to estimate the size of the farm needed to earn a specified return. We just talked about that a little bit. We can use budgets to help develop a production and marketing plan. We can use budgets to uncover costs that we may not have realized existed prior to that. How do we implement the budgeting process? We're going to implement the budgeting process so that we can provide documentation to all stakeholders. It might be particularly relevant to some of those outside stakeholders like lenders that might be a necessary stakeholder if we need to accommodate some growth in the transition process, for example. Estimate the amount of rent that we can pay for land or machinery. As we grow the operation, we might have to rent some more assets, procure some more assets to grow that operation to the size and scale that it needs to be to accommodate the transition. Identify production and financial risks. We'll talk about that here in just a few minutes. Monitor cash flows and compare actuals to projections. An enterprise budget is nothing more than an organization of the revenues and expenses and profit for a single enterprise. Now, we have seen a financial instrument in the last video segment that I mentioned was a representation of revenue, expenses, and profit for the whole farm, that being the income statement. Here we're talking about an instrument that represents projected revenue, expenses, and profit for a single enterprise. So you can think of an enterprise budget as an enterprise-specific income statement projection. So we're going to use that to identify the most profitable enterprises, to identify bottlenecks to profitability within a particular enterprise, and again, think about it like an enterprise-specific income statement. Each type of crop or livestock is a separate enterprise. The cow-calf enterprise is an enterprise, the stocker enterprise is an enterprise, rented land wheat is an enterprise, owned land wheat is an enterprise. You get the picture. The base units that we typically use in an enterprise budget, for crops it's usually on a per acre basis, for livestock it's typically on a per head basis, but that certainly would not have to be the case. Those are just some examples. There is an example enterprise budget embedded in the workbook on the website and numerous other examples that are available there under the associated reference materials. A cash flow budget is a summary of the projected cash inflows and outflows. I think I mentioned this in the last video segment. The cash flow instrument can be used either as a historical document in its statement form or in a budgeting context when we use it as a projection. And again here, timing is the issue. Trying to project when we will need cash, when we will have extra cash available, so that we can make plans for operating loans, capital purchases, etc. Again, timing is the important factor to consider here. When do we have to make loan payments? When will we need to borrow more money? Develop a borrowing and debt repayment plan and suggest ways that we might need to rearrange commodity sales and or purchases of inputs and capital items to more align with our cash availability. We can help identify the consequences of the timing of purchases and sales, capital expenditures. A friend of mine used to always say, the cash flow budget is the financial instrument that gives us the courage to move ahead with the farming operation. We're dealing with a lot of dollars in this day and age, and we need a little bit of courage. We need to have at least seen some numbers in some type of a plan that, hey, this thing will work out. We're going to be able to pay off these expenses and pay back the debts that we've borrowed to finance this operation. The cash flow budget helps to give us that courage in a lot of regards. Partial budgets are another tool that we use when we're evaluating the financial feasibility. We're going to focus with the partial budget on costs and benefits of alternative plans on just a tiny part of our farm. We're going to evaluate small changes. So we're going to consider only the cost and return items that will change if we pursue this alternative strategy as compared with the existing strategy for example. And I'll give you a specific example here in just a second. We're going to use this well-organized tool to isolate the impact of that proposed change. And it's a systematic organization of that thought process so that we don't overlook something. We're going to evaluate possible changes in the operation that involve perhaps multiple enterprise budgets. So it's a systematic way to organize that information. Fine-tune the whole farm plan, if you will. And again, provide some consistency to the thought process. We're going to emphasize changes. The typical format that you'll see a partial budget laid out in is compared to the existing alternative. We're going to look at the positive impacts. That's going to be what additional revenues will be generated if I go off in this direction as opposed to some other direction. And we're going to look at the negative effects. The positive impacts are going to be additional receipts or reduced expenses. The negative impacts are going to be added expenses or reduced receipts. So think about weighing the alternative of custom hiring an operation done versus doing it ourselves. There probably aren't going to be many added receipts if we custom hire something done as opposed to doing it ourselves, but there would be some reduced expenses possibly. Fuel and oil and labor and depreciation and all of those machinery costs that we would incur if we owned the machine and did it ourselves. On the other hand, there'd be some negative effects associated with custom hiring an operation done. There'd be some added expenses, right? We have to pay the custom operator. Again, probably wouldn't be any reduced receipts in that particular example, but we add up all of the positive impacts and all the negative impacts in a systematic manner, take the difference between the two, and that's the net effect of pursuing the proposed alternative as opposed to sticking with the original plan. So it's just a systematic way of looking at changes in our operation without having to go through a complete financial analysis every time we want to make a small adjustment or want to consider a small adjustment. Finally, when we're thinking about financial feasibility, I'd be remiss if I didn't mention risk. What is risk? Well, in a nutshell, I've tried to word it in pretty plain language here. Something bad could happen, and if that bad thing happens, it's going to have an impact on your business. From the standpoint of a farm management economist, I'm probably talking about something's going to have a bad financial influence on your business. So risk management involves choosing among alternative courses of action that have an impact on perhaps both profit and risk. The objective is not to eliminate all risk. We haven't had time to talk about that in this particular video series, but it's widely known that the only way you can make a lot of profit is to take a little bit of risk, right? There is a reward out there in the general market, in the general business world for taking risk. So risk management is not about eliminating all risk. It's about finding the optimal risk for your operation at your particular stage of your business. What risks am I willing to take on internally? What risks do I need to shed off to others and perhaps pay somebody to take in place of taking them on internally? So which strategies are right for you as you pursue a farm transition? It's going to depend on ability to bear risk and willingness to bear risk. Ability to bear risk is basically wealth. How wealthy are you? How much money do you have? But the one that really comes into play when we start thinking about a business transition is this risk attitude concept. And the reason that it's important to consider when considering a family business transition is because different people have different attitudes, beliefs, and needs as they think about risk. For example, your perception of risk is probably going to change as you age. So generationally, there are differences in attitudes toward risk. For example, as you accumulate more wealth, you develop a different attitude toward risk. So different people are going to have different perspectives about what enterprises you want to pursue, what production practices you want to pursue, their comfort level with debt to facilitate growth, all of those kinds of things. And in the middle of a transition, when you have several stakeholders involving perhaps multiple attitudes, multiple generations, multiple beliefs about taking on risk. We have to have, again, one of those communication sessions, one of those discussions about, hey, what is going to be our risk management strategy going forward? And is the way we've been running this thing historically consistent with the needs of the incoming generation, and will it facilitate this transition process? With that, I thank you for your attention in this video presentation. Again, more information, the handbook and supplementary materials can be found at agecon.okstate.edu/farm transitions. And I'm Rod Jones, and again, thank you for your participation in this video series.